Hey everyone, welcome back to Corporate Decoder. Today we're diving into a financial filing that is packed with details about how a fund operates, how it makes money, and what could go wrong. Think of it as a super detailed instruction manual for a money-making machine. And we're going to figure out if it is a well-oiled invention or a ticking time bomb. Ready to decode this? Make sure you are subscribed and join our Discord community linked in the description for more exclusive content. We're looking at a filing from JPMorgan Credit Markets Fund. This is essentially a registration statement, a document that tells the big boss, the SEC, all about what this fund plans to do, how it plans to make money, and crucially, all the ways an investor could potentially lose their shirt. It is dated December 2025, so it is pretty fresh. And it is all about their plan to offer different classes of shares to the public. So what exactly is this fund trying to achieve? Their main idea is to make money over the long haul by investing in a bunch of different credit-related things. We're talking loans, bonds, and other complex financial instruments all related to credit. They're offering three types of shares to investors: Class S, Class A, and Class I. Each of these has different fees and expenses attached, which is pretty standard in the fund world. Think of it like buying the same product but with different service packages. The brains behind the operation, the investment advisor, is JPMorgan Investment Management Incorporated. They're the ones making the day-to-day decisions on where to put the fund's money. This fund is new, it has no track record, so it is definitely a speculative play. They mention it is a closed-end management investment company and also an interval fund. Basically, this means you can't just redeem your shares whenever you want, like a normal mutual fund. You have limited opportunities to sell back to the fund. And that is a big deal for investors who might need their money back quickly. Now, let's get to the juicy part for any investor, the fees. This table here is super important. It breaks down all the costs you'll be paying. Look at the total annual expenses. For Class S shares, it is 3.59%, for Class A, it is 3.34%, and for Class I, it is 2.84%. These percentages might not seem huge, but remember these are taken out every single year from your investment. Over time, these fees can really eat into your returns, especially if the fund isn't performing well. Here is a little bit of good news though. They have a fee waiver and expense reimbursement program which brings those total expenses down. So after that waiver, the actual cost of owning Class S shares is 2.84%, Class A is 2.59%, and Class I is 2.09%. Still, it is important to remember that these waivers are often temporary and can be changed. Then you have the examples. These show you how much you'd pay over 1, 3, 5, and 10 years on a $1,000 investment, assuming a hypothetical 5% annual return. For Class S shares, after 1 year, you'd pay $29. For Class A, it is $48. And for Class I, it is $21. This really highlights how those differing fees add up. Let's also talk about sales charges. On Class A shares, there is a front-end sales load. If you buy $100,000 or less, you pay 2.25%. That is a direct hit to your investment right up front. For larger purchases, it goes down. Class S and Class I shares don't have this upfront charge, but don't get too excited yet. They can have other fees. Okay, now for the section nobody likes to read but is absolutely critical, the risks. And this filing has a lot of them. The overarching theme is the risk associated with credit investments. They're basically saying that the companies or entities they're lending to or investing in might not be able to pay them back. This is a big deal because a huge chunk of their strategy relies on these credit investments. A major red flag here, they invest in private companies and there is less information available about these companies. Plus, these investments are not easy to sell off quickly. This means the fund might be stuck with assets that are hard to value and even harder to get rid of if they need cash. They also invest in other funds called portfolio funds. This means they're indirectly exposed to all the risks those funds are taking on. It is like investing in a company that invests in other companies. The risk gets layered. They are a non-diversified fund. That is a crucial point. It means they can put a large percentage of their money into just a few investments. While this can lead to bigger gains if those investments do well, it also means a single bad investment can have a massive negative impact on the whole fund. It is high reward territory. And finally, valuing these investments is a big challenge because they're investing in things like private companies and other funds that don't have readily available market prices. Determining their true worth is tough. This difficulty in valuation affects how they calculate their net asset value, which in turn impacts fees and transactions. Looking at the management team, they have a board of trustees, and importantly, a majority of them are independent, meaning they're not directly tied to JPMorgan. This is a good sign for investor protection. The investment advisor team has significant experience in private credit, managing billions of dollars. They detail their investment process, which seems robust, focusing on sourcing, due diligence, and ongoing monitoring. The primary portfolio managers like Brian Coleman, Mary Rooney, and Lynette Ferguson all have impressive backgrounds in finance. Their experience is a strong point, but as we've seen with other funds, even the best managers can face market headwinds. This agreement lays out how the advisor gets paid. They get an advisory fee of 1.00% of the fund's net assets annually. However, there is a temporary reduction to 0.25% for the first year to help get things started. Also, the advisor has agreed to waive fees if certain operating expenses go over a certain limit, capped at 1.10%. This is a common practice to make the fund seem more attractive and to control costs in the early stages. Now, let's peek at the actual financial statements. Since this fund is brand new, the financials are pretty basic. As of the 25th of November 2025, their total assets were $953,588. This primarily consists of cash and some deferred costs. Liabilities are also around the same amount, meaning their net assets are $100,000. This $100,000 is the initial capital that got the fund off the ground, mainly from the advisor. For the income statement, it is almost entirely $0 for net investment income. This is expected as the fund had just started and hadn't made any investments yet. The organizational costs were fully reimbursed by the advisor, which is good for the fund's initial cash position. The notes to the financial statements provide more detail. We see the advisor advance the initial organizational and offering costs, which is standard practice for new funds. They are also committed to a fee waiver for the first year, which is meant to keep initial investor costs down. Looking at this filing as a whole, JPMorgan Credit Markets Fund is aiming for a slice of the credit market, a place where many investors see potential for good returns. But as the risks section makes abundantly clear, it is not for the faint of heart. The fund is non-diversified, meaning more concentrated risk, and it invests in illiquid assets, which means you might not get your money out when you want it. The complexity of their investments in other funds also adds another layer of risk that is hard to fully grasp. The management team seems experienced, and the fee structure, especially with the initial waiver, is designed to be attractive. However, those long-term fees and the inherent risks of credit markets, especially involving private companies, are significant hurdles. My take is that this fund could be a decent option for sophisticated investors looking for high risk, potentially high reward exposure to credit markets, and who understand and can tolerate the lack of liquidity and valuation challenges. But for the average investor, the complexities and risks might outweigh the potential rewards. What is your take on this fund's strategy and its risk profile? Are you intrigued by the credit market, or does this sound too risky? Let me know in the comments below. If you found this breakdown helpful, please smash that like button, subscribe for more corporate financial deep dives, and join our Discord community. Thanks for watching. See you next time.